There was a period early in my trading career where I understood everything about the markets. I knew exactly what to look for, but I still could not become consistently profitable. I could analyze charts, I could identify trends, I could find the right setups, but when the time came, I would just completely freeze up on my entries. I'd stare at the screen, second guessing myself. Should I buy here? What if it reverses right when I get in? Where is the actual spot that I should be buying this stock? And even when I finally did enter, I had no confidence or conviction to let the trade play out. I'd take profits way too early because I was too scared to give back gains on the trade, or I'd hold way too long trying to catch an absolute home run when the setup was not conducive to that move. And that's the gap nobody talks about. You can watch a ton of YouTube videos, you can have a ton of different information, but when the time actually comes to execute, do you have a system that you can follow? Do you have a checklist that makes sure that you don't have second guessing, or you're not second guessing every single time you enter a trade? Knowing what to look for and knowing when to act are actually two completely different skills. And most traders never figure out the second one. It took me years of trial and error to find the actual sweet spots of when to enter a trade and develop a system for my execution. And I call this the entry Bible. This is a checklist I go through every single trade to make sure when I'm entering, everything that I want on this trade is lining up. That way I don't second guess and I enter with complete confidence. Once I had the system, everything changed because I wasn't second guessing anymore. Every single time I'd enter a trade was with confidence. Even if the trade didn't work out, I knew my system worked over time, and all I had to do was stick to the system to make consistent money in the markets. Now, this is episode 5 of the swing trading series. If you've watched episodes 1 through 4, you know exactly how to find the right setups. You know how to use trends in the market. Now you have to actually execute on these setups. And this is what this episode is all about. I'm going to give you guys the exact entry checklist that I use, the 4 things that align before I take any trade in the markets. I'm going to show you exactly where to put your stop loss so that you don't get shaken out, but that you manage your risk as well. And I'm also going to break down my exact exit strategy that allows me to hold winners for a long period of time and use the momentum in the market to carry my winners for longer. By the end of this video, you're going to have a complete system to executing trades, knowing exactly where to enter, knowing where your stop loss should be, and exactly where to exit the trades so that you don't exit too early or that you don't exit too late. So let's get straight into the video. The entry should be one of the easiest things to do in your process. The most important thing with this strategy is understanding the type of setups and identifying the setups that we're going to be looking to take. We're going to learn how to do exactly all of that in this episode. Now, to start it off, we're going to talk about the entry models that I use, and there's going to be 3 of them. And the reason why I'm going to be covering 3 is because of the fact that sometimes the market conditions change. If you're still watching this by now, you know that swing trading is the best way to make money in trading and actually have long-term profitability and longevity within trading. And many of you don't want to quit your jobs. You don't want to risk it all. You don't want to change your lifestyle to become a trader. What you want to do is have another source of income, another wealth generating tool, and something that you can do on a day-to-day basis to make consistent money. And that's exactly what this is, and that's exactly what I'm teaching you. And if you're interested in learning more about how you could do the exact same thing, you can check out the link down below and sign up to the 3-day live swing trading challenge. This is where I'm going to show you how to be able to do all of that, the exact framework that you need, and everything that you've been taught completely wrong for the past few years. So if you're serious about becoming a profitable swing trader, now is the time to do so. Now is the time to lock in. So click the link down below and reserve your spot for the 3-day live swing trading challenge, and I'll see you there. Now let's get right back into the video. All right, so for our first entry model, this is going to be our breakout entry model. And the most important thing about this entry model and being able to enter stocks at the right time using breakouts is to be able to identify the right setup. You want to be using the daily time frame because the daily time frame gives us the biggest setups within the market. And you also want to be looking for a stock to be compressing. Like we talked about before, stocks move in staircases. In a trend, you have a big move up, staircase, and then big move up. And what we're looking for is that compression within the market to be able to catch these big moves. So I want you to think about a stock kind of like a spring. It gets coiled, 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 filled, then it starts to make a massive move to the upside after breaking out of that range. So what we want to look for is that compression. We want to be able to find that compression within the market because that is where the biggest moves are going to happen. So for this example, you could see this stock makes a pretty big move up. It gets coiled like so, builds this kind of bull flag into the moving averages, and then boom, look at when it starts to break this level right here. It starts to absolutely go insane and make a massive move higher. And what we're looking for is that setup first. We want to identify the setup first before we even look to take an entry. The first thing we should be looking to do is find that setup, and we want the volume to be declining. As we talked about in last episode, the volume needs to be declining as the stock is setting up, and then we're looking to trade this big breakout that is going to happen. So how do you actually start to identify these setups? Well, the first thing that you're looking for is compression. So you want to see the stock make a pretty nice move up like so, and then pull back into the moving averages on declining volume. And a pullback will look something like this. It's very controlled. It's very slow. You'll notice how the stock doesn't just go up and then straight back down. A pullback means the stock makes a very big move up and it pulls back about maybe 40-50% of the move. It doesn't pull all the way back down. If it pulls all the way back down, it's not a real setup. It's probably just going to fake out, and it's probably going to go lower and not continue to play in the direction of the original move. But if the stock starts to set up like this, doesn't pull back more than, let's say, 50-60% of the original move, then it starts to consolidate and tighten up. And notice how when it's going down here, it's doing so very, very slowly. And that's exactly how you know that a setup is brewing. Now what you want to do is start drawing out the pattern that is forming. So usually you'll have some sort of bull flag, a wedge, you'll have an inverse head and shoulders, a cup and handle. But the most important thing to understand is the actual names of these setups don't really matter, and the pattern doesn't really matter much either. The most important thing is just noticing that compression and identifying the fact that a stock is getting tight and it's getting ready to potentially break out in the next few weeks. Once we start to notice that a setup is forming, we can start to draw this as a resistance line like so, and then we could start to draw a support line. All this tells us is that compression is happening, and the more a stock starts to compress like this, and you could see that the support level is getting a little bit kind of compressed to the upside, and this resistance level is getting compressed to the downside. This is kind of called the apex of the pattern. Eventually, at some point, we either break that support level or we break resistance, and we have to make a pretty big move up. So when a stock starts to get very compressed like this and the resistance is declining and then the support is kind of going higher, that tells you the stock is probably getting ready to break out. So when you start to kind of enter that last point of that consolidation, the big move is usually about to play out. Now, a lot of traders will just use a trend line like this, so a resistance trend line, and then buy the stock right as it's breaking that resistance. But what I like to usually do is I like to use also a key level of resistance, a horizontal level of keys of resistance, because of the fact that a lot of time a trend line could be pretty subjective, meaning I could change the trend line kind of to my liking. I could choose kind of which level I want to use, but when you're using a key level of resistance horizontally, it's very objective because you can clearly see, okay, this stock has rejected this level, this level, this level multiple times. Now we can say, okay, this is the big level of resistance that we need to see the stock break above for the big move to kind of start. Now, this is one of the most important parts of this entry model. You have to be able to identify a key level of resistance or support if you're looking to short, to be able to find where the breakout is going to happen and exactly the level that you need to be using to be able to buy the stock as it's breaking that key level. Now, what I usually like to do is combine these two things. So I combine the trend line with the level of horizontal resistance. That way I have a big confluence that the move is going to happen. So once I identify the setup, then I identify the level that I need the stock to break above. Now all I have to do is set either an alert on the breakout like this, or just watch the stock the day after, or whenever it is, getting ready to break out or getting close to that level of resistance to be able to trade the breakout. You want to do all this on the daily or weekly timeframes. You always want to find your setups on the bigger time frame. Do not use the smaller timeframes to find your setups, because we're looking at the daily moves. We're looking at the big momentum moves, because you could see when the stock starts to break out right here, you're getting a 63% move on the stock. You can't get this in one day. Usually, right? Obviously, there's some outliers. Some stocks do move a lot during the day, but most of the times you're not going to get a 63% move in one day. You'll get it over a few weeks like this. And if you can catch something like this, that's an account changing move. Now, once we have our key level of resistance and the level that we're looking to trade the stock above, we want to go down to the lower time frames now to be able to get our sniper entry. I usually like to use the 5-minute time frame for this. You can also use the 10 or 15-minute, but this is going to help us identify the exact level we want to look for right when we are looking to buy. All right, so here we go on the lower time frames. You can see this stock starts to break out of that trend line. Now, a lot of breakout traders will like to buy the stock right as it breaks that trend line. That's something that you could totally do, but I like to use confluence because sometimes what I see is, again, because the trend line is pretty subjective, it'll break the trend line and then it will reject that key level and then come all the way back down. And a lot of times you'll get kind of stuffed on the move. What I like to do is confirm these two breaks that are happening with the trend line break first, and then obviously the level of resistance being taken out as well. So you can see the stock opens up, makes a nice little push higher, and then it starts to consolidate until it finally kind of continues to push higher. But we're not in the trade yet because it has not broken that key level of resistance. We need to wait for a break above, and the confirmation is going to be volume, right? So let's watch this as it plays out. You can see it sets up right on their level. Boom, right here it starts to break out, and notice what happens as the stock is breaking the key level, right? Notice the volume is rising higher, and this is what we talked about last episode. When the volume is above the average cloud, that tells us that a big breakout is going to happen, especially if a stock clears that level that we need it to clear. And that is where the big move is going to be happening. And this is going to be our exact entry. So we're not waiting for anything fancy. We're not waiting for the RSI, the MACD, or any of these other indicators. All we're looking for is 1, price, and 2, volume. If we can combine these two things, we now have an incredibly profitable strategy without making things super overcomplicated. So all we need to do is wait for the stock to break the key level. We need to see volume come in as the stock is breaking that level. And that is going to be our entry on the 5-minute time frame right here. Now, the most important thing is understanding where the stop loss is going to be when you take this trade. So the stop loss is always going to be at the low of day, meaning the day that you bought the stock. So today right here, the lowest point that the stock traded during the day. So you can see it's obviously right here at these lows. If you don't know how to find this, you can find it on your broker. You can find it on TradingView right here. It says, the low of the day right there, and you'll be able to put the low right here. So what we want to do is put the stop loss right here, kind of mark it out like this. And no matter what happens, guys, if the stock takes out the stop loss, you're going to be exiting the trade no matter what. Don't give it a second if, don't give it a but. If it breaks that level, you're going to be out of the trade. The most important thing about this strategy and trading in general is to manage your risk. You want to keep your losses small because our winners could be absolutely insanely massive. All right, so going back to the daily time frame, you could see that now we have our solid entry right here. Our stop loss goes to the day's low. And then from here, you can see the stock ends up trending and continuing to push higher and push all the way to the highs of this range, give us our first target and continue to go higher. Now, the most important thing is look at the risk to reward that you're getting on this setup. It is absolutely amazing. You took the trade right here, put your stop loss at low, and just for being able to sit in this trade, you're getting a 3R. And that doesn't even include the fact that the stock will probably continue to go higher, which you could see here it ends up doing in a few kind of moves here, and you're catching just a massive move on the stock. You can see right here, and then this ends up being a 11 risk to reward on this trade. And this is why it's so important to have such good entries and be able to use this entry strategy and tactic, because if you get a really good entry right here, you just caught a massive trade and then an 11R. All right, now before we get into the next entry model, I want to really solidify and help you guys understand exactly when you're going to be looking for the entry. So we're going to look at another example here. This is the ticker Tesla coming off of a pretty strong trend. You can see right here, it made a pretty big move up, started going sideways, built out a nice base, and then broke out again, made a nice move. Now notice what it's doing here, right? It's setting up in a tight base again. And again, doesn't matter what pattern this is. Technically, this is an ascending triangle, but that doesn't really matter. The most important factor about this setup is that there's tightness, right? So you're not making any new highs. You're not really making any new lows. You're kind of just consolidating like this. And this is one of my favorite setups because you're making actually higher lows as the stock tries to push up, right? Which is telling you that it's ready to break out and make the big move up through these highs. Now, the most important thing again is you want to see the volume declining as the stock sets up. If the volume is declining as the stock is setting up, now you're seeing the fact that there is very low volume and the fact that there is probably going to be a compression and an expansion move that happens out of this compression that is setting up in the stock. All right, so now that we have a compression right here and we have our staircase setting up, we want to be able to identify the level that the stock needs to break in order to make the big move up. And this should be very simple, right? What is the level that the stock has not been able to break above? It's very clear that it is right here. You have 1 rejection, 2 rejection, 3 rejections, 4 rejection, and pretty much a 5th rejection right here. And as long as you have more than 2 or 3 rejections, that level is usually very valid. Now that we have our level on the daily time frame, we can come down to the 5-minute time frame to be able to get that sniper entry. So the levels marked out on the daily, and now we come down to the lower time frames. All right, so right off the rip, you could see this stock starts to break that key level right off the morning. And again, we do not want to hesitate. We do not want to look for any extra confirmations. We don't need extra confluence. All we need is the break of this level, an entry right here as the stock breaks the level, and then the stop loss goes to the low of day right here. So that's going to be our stop loss. And sometimes you might be wondering, like, this is such a tight stop loss. That's exactly what we want. If we can have a very tight stop loss, guys, imagine you can put in about 5 to 10% of your account on this trade and only risk less than 1% of your account for that trade if the stop loss is so tight. And imagine this thing goes about 10 or 20R. You made about 10 to 20% on your account by risking only 1%. That is the strength of the strategy, to be able to put on size at the right area with taking very limited risk to be able to catch massive movers that have a lot of momentum in the market and that are the leaders in the market. And we're going to be talking about how to identify all these stocks and setups in the next episode as well, so that you know how to find these stocks that are leading the markets higher. But this is exactly where you're going to be looking to enter. Right here, you can see the stock ends up breaking our level. This is going to be our entry right here, right as the stock breaks. And you can see the volume is incredibly high. It's above the cloud, which is exactly what we look for. And then from there, we can get a pretty nice move on this stock right here. Another entry that you can take as well, if you end up missing the original breakout, guys, is a retest. So if the stock comes back down to retest that breakout level, we could actually use that to take another entry. So a lot of people might miss the original breakout. Remember, if the stock comes down here and it retests and it holds, that could actually be another entry as well. But you could see this stock never came back down. It just kind of started running and making a massive move up because of the fact that it just had so much momentum. And then, you know, it just continued to push higher and higher and higher. And if you were in this thing, you made a ton of money on this move up. And again, just to show you how lucrative this setup is, this was your entry, this was your stop loss. And if you just held it 2 days, you made a 29R trade, right? And that doesn't include the fact that if you would have held it for a few more days, this would have continued to push higher. And then this probably would have been about a 67R trade, which is absolutely insane. That is, if you're putting in $100, right? And that is going to be our entry on this stock. Now, last example of this entry model, we're going to use the ticker NVIDIA. This is actually one of my biggest trades of all time that I took. You could see this stock is setting up in a massive base on the daily time frame. And again, remember, nothing too fancy. All we have here is consolidation. And that's the most important part. We have a clear level of resistance that the stock has respected multiple times right here. You can see we have 1 rejection, 2 rejection, 3 rejection. So all we're looking for is a break of this level. If we can get a break above, then that means the stock is ready to probably break out. You can see the volume is going lower and lower and lower, which is telling you that it's ready to make that big move. Now, again, once we have our daily level that we need the stock to break above, all we want to do is go down to the lower time frames to get our sniper entry. So we come down to the 5-minute time frame. Now, once we're on the 5-minute time frame, we wait for the stock to open and then we wait for the break above our level. So we don't want to trade it here. We don't want to trade it here. We want to trade it right here. I know that sometimes it might be a little too late, right? Because obviously you would have loved to get an entry right here, but you don't know if the stock is going to break out. Right here is going to be the exact entry that you want to take right here on the break. And then you're going to use the low of the day as your stop loss right here. That is going to be our entry. And again, notice the volume. It is absolutely incredibly high. It is much higher than the open as well right here, right as the stock is breaking that key level. And that is your confirmation, guys. You must look for volume. Another reminder, look for volume before and after the breakout is playing out. If there's a lot of volume as the stock is breaking that key level, the breakout is probably going to play out and give you a massive, massive move. So this is going to be our entry right here. Our stop loss is going to be going to the low. And then obviously you can see this thing ends up making a massive move higher on the breakout. Again, this was one of my biggest trades of all time. And if you miss the breakout, you can wait for the retest. The only reason I wouldn't wait for it is because of the fact that sometimes a good stock like this, guys, is not going to come down to retest almost ever. I actually don't think this stock did end up ever retesting back into this level. It just kind of ran from here, and you can see on the daily time frame, it just went on a massive tear higher, and you got an amazing entry right here. And again, let's look at our risk to reward. We bought it right here. We put the stop at the low. Just holding it up to here is about an 18R. And obviously that doesn't include the fact that this thing goes on an absolute tear from there as well and makes a massive move up. And this is why it's so important to have a good entry and use this entry model. All right, so that's our first and best entry model, in my opinion, at least, and the one that I've had the most success with. Now, just remember the fact that this doesn't work in every single environment, because obviously if the market is choppy, you're not going to see big moves like this play out, and a lot of times the breakouts are going to dissipate. So you want to make sure that the environment that you're in is very, very strong and conducive to breakouts. You want the markets to be above all the moving averages. You don't want them to be chopping and sitting like in a massive range. And also use this on the market. If the market is breaking out of its range, you're probably going to see a big move in individual stocks, and you're going to have a lot of momentum, and that's when the breakouts are going to work the best. So going on the weekly chart on the NASDAQ, you could see the exact example that I'm alluding to. You could see whenever the market breaks out of a massive base like this is when breakouts are going to work the best. So you have a massive move playing out in the market, and a lot of breakouts are going to work in individual stocks. But when you start to chop like this and set up, probably not going to see a lot of breakouts working. But again, the moment it starts to break out again, you're going to see a massive move in the market and also a massive move in individual stocks. So just remember, right now the market is chopping. You might be seeing this at a different time than when the video is posted. But if the market is chopping like this, breakouts are not going to work as well. And the fact that, if the market is breaking out, that's when the breakouts are going to work best. So if this sets up and let's say it breaks out to the upside, that's when the best moves are going to happen in individual stocks. So just always keep that in mind. All right, guys. So our second entry model, this is going to work best for when the markets are choppy and are not making any massive moves up or massive moves down, is going to be our undercut and rally strategy. What this means is basically waiting for a stock to have a failed breakdown to the downside and then reclaiming that level and making a big move up. A lot of you probably heard of this concept called a liquidity sweep. This is pretty much exactly what the UNR is. So a stock will sweep a key level of support. It'll get back through it and then make a massive move higher. All right, so the undercut and rally setup looks something like this. So we still have the same idea of a stock making a big move up and setting up within the staircase. Now, when the market is choppy, usually what ends up happening is instead of the breakout to the upside like this, you get a failed break to the downside like so, and then a stock will reclaim the level and then break out to the upside. And instead of buying the breakout in a choppy market like this, we can actually buy the undercut and reclaim. So the moment the stock breaks this key level right here of the base, and then we get a reclaim of that level, can actually be our entry right here. And then our stop loss goes to the low of the range right here. So we get a beautiful entry before the actual breakout happens. Now, a lot of people might ask me, why don't I just trade this type of entry every single time during any market? Now, the thing is, usually during the strongest markets, what you see end up happening is that you won't actually have these UNRs set up because stocks are so strong and momentum is so available in the market. You only have the big breakouts that end up happening. But this is a great entry model to have in your tool belt if things do slow down, if things become a little bit choppy. And even during markets that have momentum, usually and sometimes you'll still see these UNRs play out, and you'll be able to catch some really nice reversal setups and also be early in the trade before the breakout does happen. All right, so here's an example of a perfect UNR setup that's set up on this ticker right here. You could see we still have the same exact setup. We're looking for this tightness to set up in a stock. The only thing that changes is instead of buying the stock as it's breaking that level of resistance, we're actually looking to enter near the lows on a failed break below this level right here. So you can see this is going to be our key level as the stock was trying to hold this spot. This is going to be our support, and all we're looking for is the stock to break that level and then trade back above. Now, the only issue with this setup and this entry model is the fact that it might be a little bit harder to know exactly when a stock is UNRing. What I usually like to do is do something like this. So if I'm looking for a stock to break a key level and then reclaim it, I'll set an alert at this key level like this. So I'll do add alert on RKLB, and then I'll do value, and I'll do crossing down like so. And then I'll also go into it again into that same level, and then I'll do crossing up. If I get the 2 alert, that tells me the stock broke that level and then it reclaimed and got back above for our UNR to play out. Now, once we find our key level of support that the stock is breaking below and getting back above for our UNR, what we want to do is again go down to the lower time frames, as our lower time frame is always going to be where we get our sniper entry, and our daily time frame is where we're going to be getting our key levels and the setups that we're going to be looking for to enter on the lower time frames. Now, once we have this setup and we have the key level, we can come down to the 5-minute time frame. If we get the alert, that also helps us to identify that we do have the UNR in progress, and we can be looking to get our entry. All right, so here's the lower time frame. On the 5-minute time frame, you can see we have a big move below our key level, and then boom, right here is going to be our reclaim. And again, just like the breakout entry model, all we're looking for is a break above. We don't want to look for any confirmation. We don't want to look for any hidden kind of confluences. All we want to see is price reclaim the level, and then we want to see volume is high as the stock is reclaiming our level. That's going to be our entry right here. And then again, stop loss goes to the low of the day. So this is going to be our stop loss right here. That's going to be our entry. And then we can look to trade this as it continues to go higher. And another entry that you could take, just like the breakout strategy, is you can look for a retest of our key level. So if the stock comes back down and retests that level, that could also be used as a potential entry if it does come back down to retest. So a perfect example would be right here. The stock came back down to retest. If you missed the initial kind of UNR, you can buy it right here as well. Stop loss goes to the low. Then you can look to swing this and continue to trade this one to the upside. And again, just like the breakout strategy, because we're trading momentum and because the setup matters really more than the entry, you can see we have a really good risk to reward. So we entered right here on the UNR, and then we're looking to target these highs right here. And you can see, I mean, this ends up playing out beautifully and giving you an absolutely monster risk to reward. And as it continues to go higher, your risk to reward increases. So it's about an 8.6. And obviously this thing ends up trending higher and higher and higher and making a massive move up. Here's another perfect example of that UNR entry strategy. So you can see this stock is setting up in a massive base, very similar to that other setup that we looked at for the breakout when it broke the highs right here. But instead, you could see you could have actually gotten a really nice entry near the lows as the stock kind of had a failed breakdown right here. So if you mark out the low of the base like so, and you look for the stock to break that level and then reclaim, this is going to be our UNR setup. Once we identify the key level on the daily time frame, what we could do is go down to the lower time frames. If we get that alert, we know that the UNR is taking place. All right, so going down to the lower time frames, you could see right here the stock ends up opening up, making a pretty big move to the downside. And the most important thing is understanding you don't want to take the trade until the reclaim happens. So the undercut happens, but this is just a breakdown until it reclaims. If it reclaims, that is where the entry is going to happen. So right here, for example, you don't want to take it because it has not reclaimed yet. You want to wait for it to get back above our level, which is right here. The moment that happens and you see some volume come in, that's going to be our entry. So right here, no entry, boom, right here is going to be our entry. And you could see we're looking for a little bit more volume. That would be better to confirm. And that would set us up really nicely for a really big move. You can see the volume starts to come in a little bit. This is obviously during lunch hours, so the volume is going to be a little bit lower. But once we start to get some pretty good volume, boom, right here was our first kind of volume above the cloud, or at least close to it. Going to be our nice confirmation. We also had a nice retest. This is going to be our entry right here. And then our stop loss is going to go to this low right there. And then again, going on the daily time frame, you can see this one ended up having a massive move back up. And even if you, let's say, bought it on the breakout right here, look at how late you would have been compared to the UNR, which bought it all the way down here at $36. So instead of buying at 46, you can actually get in at 36 if you have the right knowledge of buying these UNRs and you start to identify that a UNR is taking place like this. That's going to be your entry. And then you could look to take this for a massive move higher. And obviously this one ended up giving you a massive move. All right, now our third and last entry model is going to be the 30-minute pivot. And what this one is basically a way to buy reversals at key levels with confirmation. Now, the point of this strategy and entry model is not to time the bottom. That is one big mistake that a lot of people kind of do, is they think that this is to time the bottom. What you're doing is using a level that has a high probability of a reversal. So for example, you can use the moving averages. So right here, for example, you can see the stock sets up into the moving averages, and that's when you could use a 30-minute pivot. Or if it retests, let's say, a big level of support like this gap right here, that's where you can try to use a 30-minute pivot. And you're not looking to just take the 30-minute pivot off of like thin air. It's not supposed to be a bottom guessing strategy. You're supposed to be able to look for the highest kind of probability level that a stock could be reversing at. So for this example, we're going to use the 8 EMA. So this ticker right here, LWLG, is setting up in a pretty tight flag. Of course, we want to look for it to break out, but if the market conditions are not as conducive to breakouts, we can look for that 30-minute pivot. So let's say we want to buy the stock off the 8 EMA because it is very strong and it's giving us a retest of this level where we know a lot of buyers are looking to step in. So instead of just guessing that we're going to buy right as the stock hits the 8 EMA, what we're going to do is use that 30-minute pivot for confirmation of reversal. So once we have our key level, what we want to do is obviously mark it out as well, so we know how to look for it on the lower time frames. So this is going to be our 8 EMA, so mark it out like this. And now you go down to the 30-minute time frame. Now, once you're on the 30-minute time frame, what you're looking for is basically a stock that's obviously going down into the level right here. And you're looking for the first green 30-minute candle after consecutive red 30-minute candles. So for example, right here, you have 1, 2 red candles in a row. You're looking for the first green candle that forms off the key level. So it would be this one right here. And then you're going to draw out the high and you're going to draw out the low of that candle. Now, the entry only happens when the next 30-minute candle takes out the high of that first 30-minute green candle like so. So your entry would actually be right here as the stock is breaking that 30-minute high. So if we mark that out, this is going to be our entry, and then your stop loss goes to the low of that 30-minute candle right here. So this was your entry right here, and the stop loss went to the low, and now you caught a pretty decent reversal on the stock off the 8 EMA, and it allows you to have a high probability reversal trade with confirmation that a reversal is actually taking place, and you're not just guessing that the bottom is in on the stock or guessing that the stock is going to reverse at just a random level. You're using a high probability level with a high probability for a reversal to happen, and you have a level to risk off of if the reversal is going to happen. So here's another great example. This stock pulled all the way back into the support gap right here. So you can see this is the big level of support. I'm on the 30-minute time frame right here. And you could see it has consecutive red candles in a row until it hit this support level right here, right? So this candle is red. You're looking for the first green 30-minute candle, which was this one right here. You mark out the high and you mark out the low like so. The moment the stock breaks above that high right here, that is going to be our entry. And then we're looking to put our stop loss at the low of the 30-minute candle like so. And then you have a pretty nice reversal that happens. And again, you can look for the stock to retest that 30-minute pivot high, just like the breakout, to be able to buy it right here and then catch a very nice reversal the other way. All right, so now that we have our entry strategy down and we know exactly where to enter without hesitating, whether it's a breakout, whether it's an undercut in a rally, or whether it's a 30-minute pivot, now we have to understand, okay, once we enter the trade, how do we actually manage the position? Because in my opinion, the exit is more important than the entry, because if you have a good entry, but you don't hold the trade for a certain period of time, you're not going to be able to capitalize on that trade. Or if you have a good entry, but the stock ends up invalidating your trade and you hold too long and you pray that everything is going to go the right way, and then you end up taking a massive loss for no reason and blowing up your account, you get absolutely destroyed. So you want to make sure that your exit strategy is on check. Now, we talked about stop losses. For your stop losses, you're always going to use the low of day of the day that you entered. So if I enter on a day where a stock is breaking $50, if the lowest point of the day was $49, that's always going to be my stop loss for the trade. So for our exit strategy and knowing exactly when to take profits, we're going to use 3 different things. So for this example, this is the ticker IONQ. You could see right here, it's breaking out of this big base. Now, let's say you bought it right as it was breaking this key level right here, because this lines up with the horizontal level right here and the trend line right here as well. So that's going to be your breakout. This is going to be your stop loss right here. And then that set you up for a pretty nice trade. But where are you actually going to target the stock to take profits? Now, what I like to do is go and look left on the chart. What does that mean? Well, you're looking at the previous levels of price actions. For this example right here, you can see the stock is breaking out. I want to look to see what is the most previous high or what is a big level of resistance on the left side of the chart. For this example right here, you can see it's very clear that this is going to be our level of resistance right here on the stock, because this was the highest point that the stock was able to get up to. And that is going to be what I like to call TP1, or our first target. So you can mark it out like this using TP1, and that's going to be our trade. So if we bought right here and our stop loss is right here, our target is right there, that sets us up for a pretty good risk to reward trade. So using the long tool on TradingView, you can have this as your entry, that as your stop loss to lows, and then this is your target. You can see you have about a 3.6 risk to reward. What I usually like to target for the first trim is at least over a 1.5 risk to reward, meaning if you took an entry right here, but let's say the stop loss was all the way down here, now this is like a one risk reward, and your risk is a little bit too high for the rewards. You want to make sure that either you look for a better entry or that you tighten up your risk and make sure that the stop loss is tight. Because if the stock is already all the way up here, let's say as you take the entry and your stop loss is at low of day, the risk reward doesn't make sense. You're just chasing the stock for no reason. Now, once we have our first target, what we want to do is trim 25% of the position on the first target. Now, what does this mean? Well, trim basically means instead of selling your full position, what you're doing is you're selling a portion of your position. I usually like to trim in what I call fourths. So meaning I trim 25%, 25%, 25%, and then I have runners that are left to be able to collect the extra move to the upside. Now, once you take your first trim, when a stock hits your TP1, you want to actually move your stop loss to break even. The reason why we do this is because when a stock breaks out and it's breaking a key level, you don't want it to come back down to retest that level, because if it comes back down to retest that level, what's likely going to happen is that the breakout is going to fail. So you want the stock to push away from your level. Once it hits TP1, you don't want it to reject and come all the way back down. So I move up the stop to break even to manage my risk and make sure that I don't let a green trade go red, because even if I trim a little bit and the stock goes red, I still lock in a pretty nice profit on the trade. Once you move up your stop to break even after the first trim, now we can start to look for additional targets. What I usually use from now on is I trail using the moving averages, meaning I don't sell until a stock breaks our key moving averages. So we talked about the 8, 21, and 50 EMAs. I don't want to sell the position until the stock breaks under the 8 EMA, because if a stock is going to be trending very strongly, usually what ends up happening is that it will hold the moving averages and continue to move higher. So for this example right here, you could see if I bought the trade right here as the stock was breaking out, and this is my stop loss, I'm looking for the first daily close under the 8 EMA, which is this blue line, to sell the second portion of my trim. So right here, you can see is exactly where that would happen. This stock ends up closing under the 8 EMA on a daily closing basis, and this is going to be my second trim right here. Now, a lot of people are going to panic when it comes back all the way down, and they're like, oh, I should have just sold all the way up here. But this is why you have a correct trimming strategy, guys, because if you have a strategy on how to actually exit, you'll never have to second guess. You'll know to use your strategy no matter what, and you'll be able to hold positions for a long period of time to actually have big winners. Because imagine if you sold your whole position here after one day, it didn't matter that you got such a good entry. You missed out on a massive move for no reason. And this is why I use the moving averages, because nobody is smarter than the moving averages. The moving averages are always going to be able to guide us on when the momentum is going to be running out on a stock. So my second target is always going to be a break under the 8 EMA on a daily closing basis. And then I'm going to use the 21 EMA for the next position. So right here, you can see the stock hits the 21 EMA, but it does not close under. It kind of bounces off of it and then makes new highs. Now, when you make a new high relative to the most recent pullback, so for this example would be this pullback right here, and then you make a new high, I also take another trim right here. So this is gonna be 25% of the position off as we make a new high and break the most previous swing high. And then the rest I'm trailing using the 21 EMA. So again, as long as the stock does not break under the 21 EMA on a closing basis. So for example, right here, right here, right here, I didn't sell. I only sold when it broke and closed under the 21 EMA, which would have been right here. And then that was taking off the rest of my position. And then I'm fully out of the trade at that point. So when we break the 21 EMA, I'm fully out of the trade. But as the stock makes new highs, you can also take new trims, right? So you can trim a little here, you can trim a little here. The most important part about this exit strategy, guys, is never sell your full position on the first trim. You want to be able to hold your position for a long period of time, even if it's only 50% of your position, right? Even if you sold 50% of your position here, if you would have, held on to 50% from here, you would have caught a 52% move on this move up. So even if you don't have 100% of your position, you're still making a good amount of money. Here's another perfect example of a trade that I took that ended up being an absolute massive winner, and only because I was able to hold this stock for a long period of time using the scale out strategy. So first of all, you have your setup right here. You have a big base that's setting up on this stock. You can see the volume patterns are supporting. So the stock goes up, has very high volume. This is called our ignition candle. From there, it starts to set up, go sideways. It doesn't make any new highs, doesn't make any new lows. And it actually gives you that perfect UNR, undercut and reclaim. So you can see it gets under this level of support. It fails to break under, it reclaims and then goes higher. This is your first entry opportunity. So you can start some here on the position And then the next entry opportunity that you have is on the breakout of this big massive base. Right here, the stock starts to break out. You can see volume is just pouring in on this name. This is going to be your entry right here. Stop loss can go to the low. If you took an initial position right here, you can add some more as well when the stock is breaking out. This is a big part of my strategy, adding to winners, as long as you're adding somewhere early in the breakout or the base that the stock is setting up to break out of. Now, zooming out, you can see you have a massive weekly setup on this thing. So you don't want to sell too early, but you do want to take some profits into the first level of resistance. This is called trimming into strength. It allows you to sell some of the position just in case the market rolls over or the stock doesn't give you that much follow through. And it doesn't make you always go for home runs. This is a system that lets you lock in profits systematically with an actual framework where it's not like every single trade you go for needs to be a home run. I'm not holding all these trades for 30 days. Some trades I might hold for a day and then it pulls back and it stops me out. The most important concept is that I'm putting myself in the position to get into a massive winner by having the right framework. So whenever the stock hits our first level of resistance, that's going to be our first TP. Do not skip a trim just because you think the stock's going to go higher. Always respect key levels. You want to take some profits. I know this stock literally just burst through this level, and not taking profits here and selling here would have obviously been better, but a lot of times you don't know if the stock is going to go higher, right? We're doing this in hindsight right now, but when it's happening right away, you want to always respect key levels of resistance. So this is going to be our first trim. And then what we do from there is we raise our stop loss to break even. So you could see we already have a beautiful position that we could just ride. And from here, we could just let the trade play out. We don't have to stress about it. We don't have to keep micromanaging it. All we're going to do is set an alert or trail at the 8 moving average. And when the stock breaks under the 8 EMA is when we are going to take our second trim. So right here, you can see the stock ends up making a pretty big move up. And imagine if you sold the whole position right here, you would have missed this massive move. And this isn't like a small move. This is a 51% move higher. That is a lot of gains you're missing out on if you sell too early. Now, when it closes under the 8 EMA right here, you could see that would be your second trim right here. And then when it closes under the 21, that's when we usually take off either full position or at least most of the position on that. And that was right here. So instead of selling your full position, you were able to get a trim here. You were able to get a trim right here when we closed under the 21 EMA. And you didn't sell everything right when the stock started breaking out of the level. You actually ended up being able to catch a really nice mover. And then once the stock starts to break under the 50 EMA on a closing basis, that is where you want to get out of the full position. And the reason why is because you can see what ends up happening on the stock. Yes, it does bounce back a little bit, but when a stock starts losing the 50 EMA, it's now entering into a massive downtrend. And an issue that most traders have is that they'll get a beautiful buy right here, but they won't know where to sell their position. And then they'll just watch it come all the way back down to break even or even go red. Like watch this stock just continue to sell off, sell off, sell off because now it's downtrending. You have to be able to respect the trend a stock is in, which is why we only play calls or we only play the upside when a stock is in an uptrend. We don't want to fight against the trend. The trend is our friend and it helps us sit in these positions, helps us hold these stocks for a long period of time, and it helps us stay in winners instead of being in a stock that ends up becoming a loser and goes against us. Now that's going to be a wrap for the entry and exit Bible. Next video, we're going to be covering exactly how you're going to be able to find these stocks before they're actually making their big moves, how to scan for the strongest stocks in the market and find relative strength. And I'm also going to teach you about themes and narratives and how to be able to find which themes are leading in the market and find the leading stocks within those themes that are going to drive the markets higher. That's probably going to be one of the best episodes, so make sure to watch that when it comes out, and I'll see you guys all in the next episode.